Welcome to lecture 14. Nearly at the end. In this lecture, we'll talk about financial bubbles and crisis, and the title of the lecture incorporates a phrase, stability is destabilizing. And that is a phrase that has become synonymous with an economist by the name of Hyman Minsky. And latterly, I'll be introducing Hyman Minsky and his work into the narrative, because I think that Minsky is interesting because Minsky is one of the very, very few people that has actually done a systemic analysis of financial crisis, its causes and its stages. And it is a piece of work which is elegant. I'm referring to Minsky's instability hypothesis. It is elegant and it is empirically driven. And as a consequence of that, it has a huge amount of validity as far as I and as far as this course is concerned, where we have inducted our findings from empirical evidence rather than deducted it from theory and applied it to the world. We've looked at the world and say, how can we understand that? How can we theorize about the world by observing it? So in this lecture, I'm going to cover three different parts, three different outcomes. I want you to understand the tension that exists between a market-based theory and the existence of bubbles. Shortly put, is that in markets that tend towards equilibrium, bubbles cannot exist. And yet, here we are. I want you to understand the mechanisms of financial crisis and how financial innovation, bricolage, can be the cause of that crisis. And I want you to understand Minsky's financial instability hypothesis. I want you to understand it in its broadest terms. I don't think there's any need for you to understand it in depth, but to be aware of it and to be able to describe it, I think is a perfectly admirable goal for us as we go through the lecture. So in our financialized economy that I introduced in lecture 3 or 4, something like that, is that we can extrapolate out for that and say that in a financialized economy creates conjunctural asset bubbles, and they have a tendency to burst and create crisis. And in order to underline the point, I've listed a few here. Junk bonds in the late 1980s, which was a financial investment frenzy on the buying and selling of bonds that were not investable grade. And that's the definition of a junk bond. So anything that's below BBB rating is the rating agencies rate from AAA all the way down. And once you get below BBB, it's classed as being non-investable. Nevertheless, a bunch of enterprising innovators believed that they could predict the value of bonds and the stability of bonds over time, and you created models and financial vehicles through which they could invest in junk bonds. And they did for a period of time, and they made money for a period of time until they didn't. In other words, the models didn't work. And rather like the Black-Scholes model, is that the narrative, i.e. the model, performs the economy. And then we move on to the emerging economy stock markets and currencies in the mid-1990s, which is commonly known as capital flight away from the tiger countries, Indonesia, Thailand, Malaysia. There's a contagion effect as the Americans invested heavily in American markets, pumped up the stock markets in those countries. And then when the conjuncture shifted, is that they moved the money elsewhere, sucked the money out of the markets and then led to collapse. The new economy bubble, which is very, very adequately described by Nigel Thrift in his work, It's the Romance, Not the Finance, or something along those lines. It's in the reading list online. And there's also a book that I've listed as well by Thrift, which I've found to be a very interesting read. And it's worth having a look through that if you are interested, if you have the time. But the new economy bubble was based upon digital technologies in leading up to the telecommunications and digital technologies from the 1990s and leading to the NASDAQ and stock market collapses in 2000. And rather like today, where firms are commanding huge IPO returns and stock market gains on products and technologies that, well, in this instance, they didn't. It's not the case that they didn't derive any profit. Is that they didn't derive much income either. Is that nobody was quite sure how these things were going to work, but that didn't stop a huge wholesale investment from venture capital firms and also from the markets once the venture capitalists and the investment bankers had taken these firms to market and to open to public offer. And then once the the markets or the investors had seen that really they were investing in the emperor's new clothes, is that the price of these things tumbled to the extent that very, very few of these legacy websites and technologies still exist. There's elements of Napster in some music sharing and file sharing platforms, and there's elements of Internet Explorer and other early web search engines that are built into others, but it's very, very little. And then that brings us on to the real estate bubble, which is the securitization of subprime mortgages in the 2000s, leading up to the financial crisis, 2007, 2008. And I'll spend a little time talking about that one later on, because I think that the real estate bubble encapsulates it's a good example and the best way to understand what conjuncture is and how it works and what it means. So what I will do is I'll spend some time looking in detail at the subprime crisis and understanding or unpacking the nature of the conjuncture and the bricolage that was evident at the time. Now, understanding those terms, conjuncture and bricolage, is important, I think. And the best way that I think that you can understand it is to read the paper by Julie Froud, which is called, it's by Edward Engelen et al. And it's called Frame, Conjuncture and Bricolage. And in it, the concepts of bricolage and conjuncture are preeminent, and that conjuncture, as we've already learnt, is a unique bringing together and overlapping in time and space of different dynamics that create the opportunities for financial investment. Bricolage is the tools, if you like, that are being deployed at the time, the ways in which investors of the time can create and craft innovations that exploit the conjuncture. And we'll talk about the innovations that were apparent during the 2007, 2008 financial crisis, but the period leading up to it, of which there are a number. And then, not this lecture, but in the next lecture, I'll talk about quantitative easing. I think it's important as an innovation in state financing is that you understand the nature of quantitative easing, but more than that is that you understand how quantitative easing is creating more bubbles and potentially crises. Although the crises are minor in scope and scale, they are nevertheless still considerable on a domestic footing as opposed to a global footing. And what we are doing now is that we're seeing emerging bubbles in fintech and in ESG, exchange traded funds, in my opinion, but also in other areas as well, which I will also unpack towards the end of this lecture series. But one of the ones that we must really think about is whether the stock markets at the moment are really just a bubble, a speculative bubble. Now, fortunately, Minsky gives us a model through which we can actually make those judgments. So that's what we're looking at as we go through. But before we do that, I wondered if any of you are aware of what the first recorded financial crisis was. And it is the tulip frenzy in Holland in the middle of the early parts of the 17th century. And yet the tulip is a flower. And it makes no sense to anybody from the 21st century to look back and say, why on earth were people investing in tulips? Until you consider the conjuncture. Because Holland at the time was the preeminent power on the planet. It was for a very, very short space of time. They were a maritime nation and a trading nation, which meant that there were lots of very wealthy middle-class traders, merchants back in Holland, and they were looking for ways in which they could spend their money on the new thing, the new thing. And one of those new things was tulips. So rather like the way that people will spend a considerable amount of money on attractive new smartphones, the Dutch invested in tulips and traded in tulips, to the extent that the rise and fall of the tulip prices are several times more extensive than the interest that we've seen in Bitcoin in this century. So that gives you an idea about how substantial that was. And also that as the market collapsed in tulips, is that you can also appreciate the potential that so many people would have lost their life's earnings or would have lost a considerable amount of money. And that's one of the important features of crisis, is that as markets grow, there are winners, but as markets collapse, there are losers, and the losers lose big. And we'll perhaps talk about that as we go through this. But here's a statement from the Bank of International Settlements in 2014. Now, the Bank of International Settlements, or BIS as they are known, is really an unofficial regulator of central banks, but they're also they act a little bit as lobbyists as well for central banks as well. Now, you volunteer and you sign up to be part of the BIS framework. There's no compunction upon anybody to be part of it, but for the most part, people do, or I say people, central banks do. And it's an important part of, BIS is an important part of the financial framework. Their website produces fantastic data, numerical data on credit flows and trends and so on and so forth, which is freely available if you can be bothered to find it. And that's the challenge with it, is it's there, it's all there, but finding it and packaging it is not as easy as one initially thinks. But here's a statement from the Bank of International Settlements where they talk about financial cycles. Now, from our perspective, is that we've seen financial cycles as being evidence of financialization. So this is a regulator's terminology for financialization, the financial cycle. Now, I dare say that you'll have heard of the business cycle, and you'll know that the business cycle grows and so on and so forth, but you probably never really considered a financial cycle. And I think that it's interesting that as the Bank of International Settlements has determined that there exist financial cycles and business cycles, which give you an indication that there are two complementary economies that move along together in time and space, not just the one. Now, we know that in theory, finance is supposed to drive the business cycle because it finances growth and it finances new innovations. Well, I'll show you a financial and a business cycle in a minute, and you can see whether or not that is conclusive proof. But before we do that, just some points that need to be made is that financial cycles differ from business cycles. They encapsulate the self-reinforcing interaction between perceptions of value and risk. Now, what on earth does that mean? Self-reinforcing interaction. Well, is that not things that we tell each other and share with each other that reinforce opinions that we've already heard? Between perceptions of value and risk. effectively what they're talking about here, I think, is the narratives and the stories and the discourses that are told about what's valuable and about how we go about sharing them, and that they have the capacity to self-reinforce, which ultimately performs the economy, makes it real, in other words. They tend to be longer than business cycles and are best measured by a combination of credit aggregates and property prices. Aggregate credit growth alongside property prices define the financial cycle, which again is interesting because you very, very rarely hear stories about credit growth. You'll hear lots and lots of stories about public sector financial growth or public sector debt, but that is not, as far as the Bank of International Settlements is concerned, indicative of the financial cycle. The financial cycle exists within the private sector exclusively. And that's an important thing to consider, and it's more important when we talk about sovereign debt and quantitative easing in the next lecture. So just tuck that one away for the time being. And it's the interaction between debt and asset prices and output that explains many advanced economies' poor growth in recent years. Now that's something that you're just going to have to reflect upon and hold, because we'll talk about that as it will become apparent as we go through it. Okay. So here's an example of a financial cycle. The red line is the business cycle, and it looks like somebody's given it a little pull on the right hand side and flattened it out. Well, the blue line is the financial cycle. And what's interesting is that we've put on this graph financial crises that have occurred in the US. And in the initial stages, back in the 1970s, the oil crisis, is that crises, recessions, appeared in the business cycle. More latterly, crises have occurred in the financial cycle, which have impacted the business cycle. Now, I'll come back to this graph again because I think it's a good way of explaining and unpacking Minsky's instability hypothesis. So for the time being, we'll just leave it there and we'll come back to it in a bit. Before we move on, I just want us to re-establish some of the terms and some of the concepts that we've already talked about in respect to changes in banking practice and changes in financial innovations. And the first one that we need to remind ourselves is that leading up to financial crisis, particularly in the subprime financial crisis of the 2007-2008, there'd been a significant shift in the makeup of investment banking. It predates it, but it's one of those innovations that certainly contributed towards the financial crisis. In that there has been a new business model where investment bankers were seen as being financial engineers, proprietary traders, and mass marketeers. If you remember that, we covered that in earlier lectures. And subsequent to that as well, or alongside it, is that what we saw is a rise in the derivatives market and the securitization of various financial assets. And we'll talk about those as we go through it because there are particular derivatives, and we'll explain securitization a little bit more so that you're clear about what those two concepts are concerned with. But nevertheless, rise of the derivatives market, securitization of financial of debt, of private debt, basically, in this case mortgages, coupled with banks being seen as financial engineers, trading in their own interests and exploiting mass markets through retailing, sales and conglomeration of the business, where retail banks and investment banks worked in conjunction with each other. And they were able to exploit a pool of coupons which came from household debts, household loans. Is that, if you remember, all household loans, out of which more than 50% of all debt is in households. And when you borrow some money, is that there is a fee that's being paid. So there is a flow of income. interest payments back to the banks, which creates this huge coupon pool, we've called it, which is exploitable by the investment banks through securitization and derivatives. Okay. So securitization, and it links to this concept of an originate and distribute banking model. In other words, we originate the initial loans, but then we'll distribute them off somewhere else, i.e. we'll sell them on. Is that you raise funds from outside investors through bond issues, which release liquidity and reduces risk. Now, what that means is that you can package up loans that you've sold, and you can package them together so that they look like bonds and they work like a bond. And if you remember, a bond is a fixed income instrument based upon an interest rate over a period of time. And if you package together a load of debts, you can work out what the fixed income is going to be and over what particular period of time, and how much you want to sell them for in terms of the risks and the yields and so on and so forth. But the idea being, therefore, is that if I have sold 100 millions of mortgages, then theoretically I'm now constrained about selling my next $100 million worth of mortgages. Well, not if I sell the first 100 million to somebody else and they pay me back, is that I can now use that money to sell 200 million and so on and so forth. Now, I'm recycling money and leverage, but what I'm doing is, in fact, is that I'm managing the fees, or I'm managing the income and passing it on to the third party and then claiming fees. In the second video on this Spark page, there's a very short 3.5-minute video which explains this process in simple cartoons. So don't be too concerned if this strikes you as being a bit odd and a bit alien at this stage. There's another chance for us to come back to this, and we'll do that in the middle video. So securitization is the issuance of marketable securities, fixed income securities that behave like bonds, backed by cash flows from specific assets, and as a consequence, or relative to the global financial crisis, is its mortgages. So in other words, is that people are pooling mortgages, securitizing them into bond-like instruments. There is a fee of income that goes into it that pays for them, and so they are financial innovations that have huge amounts of appeal. Yeah, it's a good way of making money, in other words. And you need various parties into it. You need the obliger, or loan customers, people who take out mortgages. The originator, the owner of the assets, i.e. the mortgage themselves. You need a special purpose vehicle which buys assets from the originator. So the originator sells the mortgages to the obliger, and then a special purpose vehicle would come in and buy them up from somebody else. Now, special purpose vehicles are companies that are wholly owned by the banks, but because they are independent of the bank, operate independent of the bank, is that none of the transactions that they undertook appeared on the bank balance sheets. So it's a way of obscuring levels of debt and levels of risk away from the banking regulators. And it freed up the banks to be able to do different innovations. So we've got a number of different things that is going on here in terms of innovation. You've got securitization, you've got the creation of a new set of derivatives, and then you've got the introduction of special purpose vehicles, as well as the conglomeration, proprietary trading and mass marketing of banks. Then you've got the investor, who purchases securities that is issued by the special purpose vehicle. So the special purpose vehicle would step in, buy up mortgages, package them, sell them off to an investor. And then there's also a credit rating agency. And the credit rating agency rates the securities, because it's the rating of the security which would determine the risk that's in it. So the mortgages that were, or the mortgage-backed securities is what they're referred to, mortgage-backed securities that were issued leading up to the financial crisis were rated as being AAA, which is the highest level of credit that you can or the highest credit the highest credit ranking, which means the lowest level of risk. Now, for comparison, the American economy or the American government is rated at AA currently. And the American economy and the American government has never defaulted on any of its loans. Never. And these mortgage-backed securities were rated as being more secure than the American government. In other words, they weren't going to fail. So if you were offered a mortgage-backed security which has been rated at AAA, is that you would, it's not a case of whether or not you're going to buy one, you would be asking the questions about how many do you have? Because this is like printing money, literally, like printing money. It's easy business. So unsurprisingly, is you get a huge growth in securitization, particularly linked to the growth of the mortgage market. Now, in understanding the conjuncture, we'd need to take all of these things into account. Derivatives, securitization, proprietary trading, originate to distribute models of banking. I can't remember if I've said securitization, but I'll say it again just to be on the safe side. Special purpose vehicles, credit rating agencies, as well as the people out in the field selling mortgages and the people that were buying mortgages. So the conjuncture is incredibly complex to the extent where it's very difficult to be able to say, well, who is at fault here? Or where did the system break down? Why did it break down? Because everybody played its part. Everybody played a role. As an example, the rating agencies is that when you rate a security is that you take your portfolio, highly polished piece of publicity, to the rating agencies and you ask them to rate it. Well, if you don't like that rating, you go to the next one. And if you don't like that one, you go to the final one, because there's only three. And you hope that that one will give you the rating that you're after, but you only pay for the successful rating. The other two that rated it that's not as high as the third one, they don't make any money out of this. So there's a kind of like an implied risk that's inbuilt in it, is that in order to get paid, you need to give something a successful or a high rating. Not surprisingly, there's quite a lot of pressure, therefore, to rate these things as being AAA. No risk at all. But the fee-paying structure facilitates that rather than there being the real risk that's underneath it. So if the fee-paying structure creates the narrative from the ratings agency that these are more secure than the American government, why should people not believe it? And it performs the market. It makes the market. It increases the saleability of all of these securities. Now, mortgage-backed securities are not illegal. They never have been. They were created in 1985. And it wasn't until we got to this particular conjuncture and later that mortgage-backed securities became problematic. And that's because something specific occurred. Just to give you some idea about the growth of securitization over the period 1996 to 2006, is that it wasn't just the US. Pretty much everybody was doing it. Sure, the US were doing it more than anybody else, but there's quite a considerable market in Europe, Australia, because Australia is a big housing market, and Japan as well. So securitization is really a global phenomenon, an international phenomenon. It's not global, is it? And there are many benefits about securitization and about financial innovation generally, as we've seen in earlier lectures. But the positive claims are that it resolves liquidity problems for banks and allows greater lending. It reduces capital requirements because of the fact that you can use you could claim the mortgage-backed security that you've bought as being capital, equity, therefore, there's an equity share that's in it, which would be part of your capital requirements, as opposed to just cash. It's just assets on the balance sheet that can be counted to it being a part of your capital requirement. It improves, therefore, your balance sheet, and thus it boosts all the return ratios. And because of the balance sheet shift to the special purpose vehicles, is that there's balance sheet risk as well as being reduced. And these things are AAA rated. which reduces risk considerably. And it also claims that it benefits other actors. It benefits the investors because they can invest in low-risk notes without the hassle of originating mortgages. You just buy the mortgage-backed security as it is in many derivative trades. It provides cheap finance and mortgages to those people that want to buy a house, the obligers. And the economy benefits because we extend liquidity, improves investment, credit rating agencies maintain the standards, markets are made more efficient. Let's look at the derivatives that are on play here now. Key derivative contracts in the build-up to the global financial crisis were the mortgage-backed securities, but they weren't new. They've been around since 1985. And then you've got what's known as collateralized debt obligations, or CDOs. And then there are credit default swaps. And then there are variations on a theme of CDO squareds, synthetic CDOs, and a whole array of different, more exotic and more abstract CDOs that are built upon the combining together of different classes of assets, but always the mortgages are central to it. Now, a CDO squared is a simple concept. As a CDO squared is just taking one CDO and then combining it with another CDO. And a synthetic CDO is the combining of a CDO with a CDS. All right. Now, those terms don't mean anything to you yet, which is why there's a shorter video that will follow this, which breaks it down and makes it a little bit more easier to understand, I think. But all you do need to know is that there are lots of different contracts being issued on the back of people wanting to buy and take out mortgages, which creates a coupon pool that investment banks use as feedstock in order to generate huge amounts of derivatives out of which everybody makes money. And that's the important part of it.